Welcome back to the channel. I'm Crypto Trend Trader, and today we're going to be taking a look at Bitcoin. Before we get started, I just want to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So here we have Kraken. This is our 4-hour chart. Basically just doing a little follow-up from yesterday's video if you check that out. We had established basically two ranges that we were looking at. One was this horizontal range right here, and the other was essentially like a upward sloping support at the bottom. And as you'll see, we're talking about basically coming down here to the bottom here, this position, and potentially taking a long off of this support that we had been coming down and touching here. And you'll see we did come straight down through that support that we had been finding, that diagonal support. And as soon as we broke below it, this is a 4-hour chart here, so we have about an hour left on this candle. And you'll see we broke down below it, and then we immediately did what you always want to see happen when you break a key support or something that's even mildly substantial to the market. Once you break that support, we come down, we immediately get a push back up, and we retest it. You see we got the retest, and then it sold back off. That's confirmation from the market that we are in fact topped out at this, that we're not going to bust back into the zone and then get continuation. So you'll see we basically topped out right there at the support line, and now you'll see we sold back off. We're getting this large wick right here, and depending how this closes over the next hour or so, I mean, it's very unlikely that we're going to get another push back up. So I would suspect it closes somewhere around this range, and I think that's going to give most people confirmation of the breakdown from this point, and then we'll get continuation. And I think the continuation is likely to take us basically down to that bottom range again. And from that support line, we should be able to get potentially a move back up to the top of the range like we had discussed previously. And you'll see that's basically going to put us at about a 10.5% range. So if we can get a position filled down here, we're looking for basically putting into a stop loss. And let's see, so if we can get filled around this part right here, what we would essentially be looking to do is, I apologize, that was UPS bringing a package for me. Switch this over here. Alright, so basically, I mean, I wouldn't run a stop loss like that. That's just how the default comes. So it's basically looking at a 10% move up, but how far down would it have to come before we basically invalidate this trade? So the way the book is going to tell you to do this, the way most traders are going to tell you to do this, you're going to take this stop loss and you're going to put it at that previous low right here. So that's where you would put the stop loss. Unfortunately, everyone does this. So it doesn't work like that, and also it's 1.6%. So if it comes down here, that's not very high risk, which isn't bad. But realistically, what I would want to do, and it's not financial advice. It's just one of my personal techniques that I use is, well, what I'll do is I'll set my initial buy order, say here at 77.75. Okay, and then I'll set the stop loss, instead of setting it where you're supposed to set it, like by the books, at 76.44. What I'll do is I'll set a second trade at 76.44, and then that'll be the entry for a second trade with potentially the same target up here at the top. But then from that point in time, I'll run a stop loss. So say I want to run, like, let's say I'm going to run a 2.5% stop loss right here. I can now take off that 2.5%. I can now pull the stop loss from this trade down to there, and then I can enter, basically, if I was going to say enter a $100 position, I would put $33 in right here at the initial position with a 4.2% stop loss. So if that gets stopped out, on your $32, you're going to lose $4 of your 32. So, or 4%, I'm sorry, of your 32. But now the second position is going to be down here where you would typically set the stop loss, and that would get triggered to enter a second long trade. So here I would put 33% of my position, here I would put 66% of my position. So it's 2 times weighted because the position is twice the size. So essentially what that means is if this position gets filled here and then we come down and the whole entire position gets stopped out. So say it was a $100 position, it means we lost 4.2% on $33, and then so like about $1.50, and then we would have lost 2.5% on the remaining $66. So basically, when it's all said and done, you're looking at it's like a weighted out stop loss of less than 4%. So it's really not that bad. when it's all said and done, for potentially this range is going to give you either a 10% or a 12% move. So either way, no matter how you look at it, you're looking at the first position would be a 2.4 to 1 risk reward. The second position is a 4.7 to 1 risk reward. So they're phenomenal risk reward positions off of a key support that we found multiple times. And you don't necessarily have to put them that close together. You could put the first one a little bit higher. But the idea is essentially, if the first position gets filled and then price runs away, you at least got a taste of it. Now, second case scenario, the position comes down, stops you out when it breaks that wick right there, and then it moves back up in your favor. So you get stopped out, and now you have to chase the trade back to the upside. As we're in this position, by putting the second position in place here, that's our safety trade. If it comes down here, instead of stopping out that first position at a loss and then moving against us, we take a little bit more risk, which in this case is not that much, and then the second position would get entered at the typical stop loss from a normal trading perspective at this previous low. So when the low gets taken out, if the price moves lower than that, typically you say, okay, I'm wrong, I'm going to get out of this trade. But in this case, what happens a lot of times in cryptocurrency is we'll get a low, and then we'll start moving back up, we'll come back down, and then we'll break through that low, and then we'll get a move up. So what I expect to happen here is we could potentially either put in a higher low so we can move up from here, which I don't think is likely. We could come down to this low right here and retest it and put in the same low and then move up from there. Or we could come down here and put in a lower low. So expect that would take out people's trades, and then you could use that fuel as rocket fuel to move back up to the upside, assuming that this sideways channel is not ready to break. So assuming this horizontal channel is not ready to break and we're just going to keep ranging right here, what would happen is you would come down here, it would punch out, we get the spring back up, so neither one of your trades would get stopped out, but the second one would now be entered, and then the move is even more profitable. You have a better price to the upside, and then you can take profits towards the end of the range, and then if it breaks to the upside, you're already in a position from the best possible position you could be in a long from. And then if we move, say, keep going back to the downside, you did get stopped out, you took about a 4% loss. If you're trading with 10% of your account, that's 0.4% of your account you would have lost on that trade. Depending how you look at it, you could, maybe you're trading with a quarter of your account, you lost 4%, you lost 1% of your account, but you're in a position that's potentially going to give you 10 to 12% risk reward ratio. So obviously that's beneficial. You're looking for essentially anything over 3 to 1 is ideal, because assuming it's a coin flip, assuming you have no edge on the market and you say either up or down every time, that's 50-50 chance of winning. So if you essentially have an edge where you can win only 50% of the time, which means you have no edge at all that means is you have to have a 2 to 1 risk reward ratio to just stay, basically break even. Assuming you just flipped the coin 1,000 times and you said heads or tails every time and you had a 2 to 1 risk reward, you would just break even over time. So if you can have a 3 to 1 or better risk reward and you have a 50% success rate, you will make money consistently in any market that you trade. So if you have anything better than that, like a 10 to 1 risk reward ratio or something like that, and you have an edge on the market, like multiple support levels, consolidation inside of a range, multiple indicators telling you something. And again, this is not financial advice, but when you can find whatever your edge is, and then you can use that, and then you can use it with proper position management, like position size management, and then risk reward, you're going to be successful at anything you do, whether you're playing poker, whether you're trading the market, or whether you're working a regular job. If you put in the time and the effort and you have enough confluence over time, you will win in a situation like this. It's not complete chance, and even if it is, you can use different advantageous methods so that even if it is just a straight up 50% coin flip, you're still going to be successful. So anyway, regardless though, we talked about, basically what happened is we came down here, we got the retest, you can see we're selling back off. I suspect we're going to come down here to the bottom of this zone. Let's switch over to the daily for just a sec. I think I had a different line in here for a candle close and I accidentally clicked on it and deleted it. I believe I had put it right about there. That looks right. Yeah, so that was where the daily close had bottomed at. So essentially that's where we were looking, maybe move the initial entry point on this position up to like that. So assuming that we didn't get too low, so you definitely end up in a position. And then like I said, about a 4% stop loss right here is nice, and then 2.5, or you could bring this down to right there. Regardless, the idea is that once it comes down here, if it comes too low, it's it's not just a fake out. It's going to keep going, continuation. But now what I was doing, I think when I actually deleted that line yesterday, is I was just throwing in the different fib levels, and I just again want to touch base on these fib levels for anybody that's not familiar, or anybody who just more convenient if I have it already up here. The blue fib level is all the way from the bottom down here, like $200 Bitcoin back in January of 2015, and that's the whole parabolic bull run all the way up to basically the end of 2017, beginning of 2018, like the $20,000 range. So that's the blue fib levels you see on the right here. And then we have on the way down here from the 20 grand range to the $3,000 range, that's our orange fib levels here you see on the right. And then finally I have the green fib level, which is from the bottom here at 3,000 up to the top here at 14,000 on this past little bull run that we went on. So now here we are consolidating back around like this $8,000 range, and you'll see where we at. That's the 618 of the blue Fibonacci. So we're finding support right at the 618 of the blue Fibonacci. So what we can expect right now, when we lost the 0.5 of the green Fibonacci, we expected that essentially we're going to consolidate under it and then see where we're going to go from there. So at this point in time, what looks more likely to happen is we came back up and tested this 0.5 multiple times and couldn't get above it, and that's right where our red zone is at for the channel that we were looking at here. So when you see this top of the red zone right here, that's the 0.5. So we can't get back above the 0.5. So if that algorithm is what plays out, the likelihood is that we're going to come down here to the 618 range, and that's 72.28. So that is basically the 618 of the green. All right, so that's our target for the green, is to come all the way down here to the 618, which also lines up perfectly with the 236 of the orange. And if you notice up here, what were we finding support on consistently all through that descending triangle? That was the 382 of the orange. So when we broke through the 382 of the orange, trading Fibonacci would basically tell us that the next likely target is going to come down there and come down to the 236. So the 236 of the orange and the 618 of the green line up perfectly. So that's what we're looking for. We're looking for confluence. So we have both those things basically telling us that's a potential target down here. And then you'll look down, and what would the next target be? Okay, on the blue, and you'll see when we broke through the blue up here, the next target is way down here in the 4,400 range. So at this point in time, regardless of what you think is going to happen in the future, this target is irrelevant, because we have plenty of time. We're not just going to dump down there. We have plenty of time to figure that out before that ever happens. We're on the daily now. So looking back here, the next potential target we have, if this really, what it comes down to is, that's our third range. Okay, 5,500, 5,700, 4,400. Those are so far out of the cards right now, they're not even relevant. Now, they're big support levels, and they line up perfectly with these Fibonacci's, so they definitely are relevant in time if we continue to sell off. But the only thing that's really relevant to us right now is the next target, and that's honestly right down here. It's 77,000 to 7,200 range. It's multiple confluence from the 236 and the 618. We've tested this 0.5 over and over again, the top of this channel, and we've been unable to break out of it. We even got that strong push up and sold off. So if we break through this range, what we can expect to happen is us come down here to the 7,100. So assuming that you are not going to trade against a trend, and you are not taking a short or a long off the bottom of the range we've been checking out, if you're not already in a trade in a short down here, you have to be careful, because you could basically, it's a 9% range. It's not really worth trading at this point in time. There's no reason to put a short in at this point in time. There's too much stuff telling you that we're likely going to get a bounce back up before we get it to sell back off. I don't think right now, with the way the oscillator indicators are looking, that we're just going to dump straight off here. We almost always get some kind of support when the blue starts coming down to the purple before they cross, which is what we're getting. And then also, you see also with this knife, a lot of times what happens is you get a jab down and then it bounces back up. So you get a jab down and then it bounces back up, and then you'll get the strong sell-off, and that could take us down into this $7,200, $7,000 range. So at this point in time, I think that's the most likely thing to happen. Is we're going to continue in this range right here until it breaks. And like we always talk about, when you're trading a range, you can trade that range and assume it's going to hold right up until it doesn't, and you're only going to be wrong one time. So with proper position and risk management, you're going going to win over time, especially if we use our edge on the market, which in this case is Fibonacci support. Over long term